Good morning. Nice being here, and I appreciate it very much for the invitation. I hope you can all hear me. Just to give you a little background in how we started and what direction we took in the real estate business, which is the only business I've ever known. I have been through 4 complete cycles in the real estate business, 2 of them recessions, 2 depressions. And one thing I learned in that is that if you had, in the darkest days of a depression or a recession, if you had sufficient capital, can you hear me? Hello? That if you had sufficient capital during that period, that you could profit very well on any upswing. The concept behind that is that the American economy will continue to renew itself even after downturns, we all know. So in the first several depression recessions as a real estate developer, I was fortunate enough just to hang on by our fingernails at the time, our company. But this last one around, I really felt that I'd seen it all and seen people like Sam who made considerable fortunes in several of the downturns, and some others who I know very well. I felt that it was time to go out and try to solicit the pension funds to step up, build a war chest, step up, and start buying real estate at pennies on the dollar. The concept behind that was that I would go for travel the country, talk to pension funds. This is 1991, which is really the darkest days of it. In that time period, I might as well have been going around with Hitler's doctrines, because the pension funds had just taken huge write-offs during that period of time. They hated real estate. They hated anybody associated with it. But one major state fund said they felt the time was right, and we got started. We did a large separate account. After that, I met Charlie Eaton, who's sitting right over here, and he said, you did very well with a separate account. You should go out there and talk to a lot of the pension funds for commingled funds. So we have done that. We've now done 15 funds, those include separate accounts, which are the same size as any one of our funds. We've done $3.7 billion in actual purchase price, not value today, but just purchase price. So we raised 3.7, we invested 3.7. A great deal of that, Charlie Eaton was responsible for helping us raise. Again, in the real estate business, I recognized several things as far as a business strategy, business plan. One is that if you don't have leverage, or you have very low leverage, you can survive any downturn. So basically, of the 3.7 that we have invested, it's invested without any leverage. We bought projects, mostly office industrial. We bought those in the range of probably 35 cents on the dollar, basically. When I say the dollar would be the replacement cost of that real estate, the way it was built at the time. And those today, we have filled them up. What we try to do is take an office building that has a tremendous amount of space for lease. It's gone through a very difficult time. It's probably been repossessed. Most of the things we bought were from insurance companies that had taken them back in the REO portfolio. What we do is we try to reestablish that real estate in the marketplace, fill it up, re-landscape it, redo the lobbies, elevators, anything that brings that up to a point where it is a Class A, or certainly a top Class B type of real estate, and we take something that was once a problem and turn it into an investment property, and that's what we've done. Off the back end, we have sold now about $1.2 billion. And over that period of time, over a period of 6 years, we have a compounded return to our investors just slightly north of 23 IRR, which is unleveraged. Can we continue and keep that up? I would say that probably not to that degree, although I still think we can do internal rate of returns in the high 18s, or the high teens unleveraged. However, one caveat to that, and that is in this exact moment right now where we've had a worldwide liquidity crisis. The liquidity crisis has also hit the real estate industry very, very hard. Every lender has stepped on the side. So many deals that were out there to be purchased or to be sold in the recent past have cratered. There are tremendous opportunities again right now. Couldn't tell you how long that will last, but we are rearming right now with two large funds to start acquiring back again, basically back to the opportunistic concept, which is where we're going to buy again at substantial discounts because there are a lot of available, I would say, very fine assets to buy at this time, even better than the past. So we're very excited about this going forward. Not excited about what's happening in the world, don't misunderstand me, but in our business where we're looking to buy at discounts, the time is right.
It is unusual for me to be wearing a sweater and Sam to be wearing a suit. I couldn't resist coming to say hi to Sam. I sit on the board of EQR. We sold Sam 6,000 apartments in 1993, 8,000, something like that. And since I'm a hometown boy, I couldn't miss this opportunity to say hi to these guys. Yeah, I just got back from Asia. I spent 2 weeks touring the submerging economies of Asia, and I was in Japan, Tokyo, Beijing, Kuala Lumpur, Singapore, Hong Kong, Seoul. I missed a city or two. And one thing, like Sam, I come to real estate from a corporate perspective, and capital flows are as important, probably more important in value creation than fundamentals. Sometimes they take fundamentals to wretched excess, and they take it to steep declines to asset value. And when you look at Asia today, and you look at the U.S. economy, and you look at real estate values, Asia is 100% dependent. Its last breath, it's on serious intensive care, and its last breath is the U.S. economy. If our economy sneezes, they're going to go into terminal pneumonia. They're completely export-driven economies. They have 20% declines in domestic consumption. You shop in the malls in Hong Kong, you're the only person in the mall in Hong Kong. There are no tourists, there are no shoppers, there is nobody. They can't pay the rents on the real estate. They had, Long Van is renting space for $5 million a foot, and there's nobody in the mall. So what that means is, long term, those countries are net trade, major trade surplus countries, and over the next 5 to 10 years, in my opinion, they will almost de facto, because they're so cheap, their books will be righted. They're not facing a $200 billion trade deficit like the U.S., and it probably will go to $300 billion before it goes to $100 billion. So we are consuming the world's goods, and that does present, as Sam said, the prospects of disinflation that I think we've never seen before. Query what that means for our customer. Our U.S. consumer can't stand a bargain. He enjoys bargains. So I suppose as prices of goods fall in the supermarkets and the stores, he'll continue spending right along and not saving here. But as I think about the real estate markets, I think about the hotel industry where we have a significant involvement. I don't know how you think about disinflation in the paradigm of the U.S. REIT markets. What does it mean when you have businesses where profits are going to probably come in? You're seeing in the stock market because the margins worldwide. Coke is having a meeting today. Talk about what's happening to them around the world, what's happening to us around the world. We have 63 hotels in the Asia Pacific region, and our profits are down 50% of last year. And half of that is currencies, which are collapsing, and half of that is the fact that the Japanese aren't going anywhere, and they had the only money in Asia, and they're not spending any money, and they're home, trying to figure out what to do with themselves. So, the world is a global marketplace today, whether we like it or not, and I think the Fed is late in cutting interest rates. In the U.S., the economy is really, really contracting on the banking level. The losses, this LTCP bailout today, and the real estate industry. There were 3 lenders on the margin in the real estate industry the last 2 years: Lehman Brothers, Nomura, and First Boston. They're all out of business. literally out of business, and they were the marginal guy that the banks, it was like they were the Japanese of lending.
They were the CMBS creators.
They're the guys who sort of created this industry that provided liquidity and would take large loans on their books and then sell them off in little pieces to Prudential and the insurance companies and the banks. And they've collapsed, literally collapsed, gone out of business. So there is a huge credit crunch in real estate, and it's the first thing that we get. We have lines. We have a private company too, like Peter's, that invests. We get phone calls from our line banks where they're 30% loan to values, and they're asking if there's any way they can get their money back because they need money. And so I think there's a huge untold story right now in the U.S. markets. I think values are probably down in the real estate industry. I agree, everything we own is worth more, like Sam said. But values are probably down 10 to 15% across trading values across the board. There isn't a lot of trades going on at the moment because we put together that bid on the Gallerias in Houston and Dallas. Yeah. This is unbelievable. This is the Galleria Mall and shopping and office complex in Dallas and Houston. 4 or 5 REITs banded together and some private investors. The players kept changing. This is like real market time info. It was $1.2 billion bid put together. Then we dropped the bid to like $1.050 billion, and the seller wanted $1.055 billion, and he walked. He walked. And what he said is, "I'm going to go refinance." Right? So he called up his friendly neighborhood lenders, and they weren't picking up the phone. So he'll be back. Yeah. But it shows you how the market kind of, he looked at interest rates falling and he said, "Oh, this is fantastic, right? I'll go refinance. I can get all the proceeds out from refinancing."
I'll give you another current story. We're buying actually 12 weeks ago, we bid on a major office building in New York City, $575 million. We were told that we needed to have a 6 in front of our bid if we wanted to get into the second round. This was at 10 weeks ago. 9 weeks ago, they wanted to know if we were interested in doing it at 600. 8 weeks ago, they wanted to know if we were interested in doing it at 590. 7 weeks ago, they were at 580. We're going to close it next week at 580, except they're taking $200 million in discounted paper as part of the purchase price. So effectively, in 12 weeks, an asset's valuation is gone from 6 something as what they thought. They thought they were going to get 6 1/4 to probably a present value of 540. However, what you have to understand is this is already a good deal because it's going to close. You wouldn't believe what's going on out there that isn't closing. I mean, deals are literally falling off in every direction.
And what's happening in the lending markets, Peter doesn't borrow, so he may not know. But we borrow a lot. And there is no, rates are falling, but spreads are double. And lenders, this is a G Capital dream.
Yeah.
They borrow at LIBOR, and
it means we got to deal with Wint again.
I know. It's back.
What could be worse?
It's but they put a floor under their rates, even though the 7-year is like 470 now. The lenders, what used to get done, we had a deal in Chicago. We were financing with a Japanese life company at 105 over, 70% LTV. It was done 3 or 4 months ago. 70% loan to value, right? This is a generic office building. I'm astonished that anybody would give us money at 105 over the treasury curve. And sure enough, they said, well, the spread is 105 over, but there's a floor on this of 6 1/4 or 6 1/2, which really means it says 175 over. That was the retrade. And so it's 105, but there's a floor of 175, and the treasury's 4 3/4. So the markets are a mess. The debt markets are a much bigger story right now than the equity markets. And the debt markets have to straighten out.
The CMBS side of the market, there's currently about $20 billion that the Goldman, Merrill, Lehman, everybody has bought from the market and what they did is they bought them, shorted T-bills against them so that they could be covered if interest rates change. That's the good news. The bad news is that interest rates actually went down, but spreads went from 50 to 200. So there's probably $1 billion of unrecognized loss,
At least.
In the CMBS market, held by all these guys, that sometime over the next, depending on how long they hold them and who's going to force them to mark to market. But the reality is that there's been a huge loss taken on paper held by the intermediaries between the time they bought them and the time they, in effect, hope to conduitize them.
But like Peter said, if you stay fairly liquid, these are the best of times in the private side that you've seen in 3 years. And because the REITs are gone, they bought 60% of the assets in the United States sold last year, and right now they're all sort of figuring out where their next dollar is going to come from. We converted our REIT we're going to convert it, Starwood Hotels, to a C corporation to save the $700 or $800 million in dividends that we would pay out, and we'll shelter some of the incremental corporate tax we're going to pay as a C corporation versus a REIT by using slightly higher leverage, but we'll still have 3-to-1 debt service coverage. So we'll take advantage of the low interest rate environment if we can ever refloat our bonds. The spreads come in, but they will come in eventually because the risk. It's a compelling buy for an investor right now. There's a company, Host Marriott, owns 300 Marriotts or something, and they sold bonds about a month and a half ago at 237 over the curve. They traded north of 425 over the curve. Their equity market capitalization is $6 billion or something like that. It's insane. Even though I don't like the equity play, the debt play at 400 over is compelling. It's an unusual looking world. I think Asia is a serious problem. I don't see Asia getting better anytime soon. If anything, it's going to get worse before it gets better. On a global scale, the Hong Kong peg is a big deal, a very big deal. Something that we don't think about that much. Normally, but since we have so much, the world is so global in our business now, we think about it a lot. And I don't think anybody really knows. I think Greenspan really does need to cut rates, provide so that the U.S. economy holds, if the stock market holds, the wealth effect holds. I think we'll be fine. If the market buckles in the U.S., it's going to be an interesting time. Sam's going to have a chance to dance a lot on the graves. There's a lot of people who are screwed up, right on the edge, upside down.
Just a couple of interesting notes on this. You mentioned, Barry, that I'm not affected because of the fact I don't borrow. But where I am affected is interesting. But I think
your buyers are affected.
Our buyers are affected, exactly. As a matter of fact, I think the building you're talking about in Chicago that you were certainly named on is our building. And we have 111 Wacker, if you know that, 1 Illinois Center. And to give you a perfect idea on that is that we put a book out, CV, Richard Ellis, put a book out to sell this building. We have no debt on it. It's a little over 1 million square feet. The target price on that building was $160 million. Which would be virtually about $150 a foot. The bids came in about 20 to 25% lower, but that wasn't a significant part. And they are all very excited. They say, well, this isn't bad. We can talk these people up and so forth. I'm looking at the right-hand side of the column, and that is because we always have to identify who the lender is to these people, unless it's all cash, which is rare on a building this size. Who's the lender to these people? Well, it's every name he just mentioned who are out of the market, who are no longer in it. Well, one of them even had Starwood as their lender, and I'm trying to figure out, where is Starwood going to come up with this on your mortgage rate right now?
Yeah.
So but we're in a position. That building, as an example, is throwing off today, based on our price and our renovation of it, is throwing off today 14.7 cash on cash per annum. So we don't need to sell it. So we're just pulling back on anything that we have out there that is for sale that doesn't hit its mark. We don't need to sell it this time. We don't have leverage, and we have seriously strong cash flows and everything. So it's a little bit different. But again, just re-emphasizing the fact that all lenders to real estate are out of the market today.
It's amazing for the market. It really is amazing. I talked to Sam a couple of weeks ago. Actually, I talked to him when I was in Asia. And it is interesting to see how the market is correcting like this without an oversupply of really anything. Nothing really got a chance to get that out of whack.
Got started.
It got announced, and you can see the construction starts
the hotel
pending. Well, the hotel business, I mean, you had an extended stay hotel. If you added up all of the extended stay hotel projects that were on the books of the companies that were public, and that they needed to build in order to justify the stock prices they were trading at, there would have been an extended stay hotel in every one of our backyards. There were about 3 million extended stay hotel projects, and those stocks have gone from 20 to 6, and they're
overpriced.
They're out of business. They're literally out of business. They have no ability to tie up sites. They overpaid for the sites. They have no ability to get the money.
There's Boston Chicken, the motel business. They are. It's the same bullshit.
It is. You love real estate guys. It's like, I always say, you see the Wall Street guys, they say, well, there's all this unserved demand for extended stay properties. Where were these people sleeping, in Central Park? They were sleeping somewhere. They were just lined up, and they couldn't sleep anywhere. They needed an extended stay hotel. So
now that we're turning into a puritanical society, maybe they need a lot more motel rooms to keep everybody apart.
It's very fortunate. I'm very fortunate to be here with Sam Zell, who certainly is the dean of this. I don't mean dean in age, but I mean dean in experience, and he's been buying as a vulture buyer, as an opportunistic buyer for many, many, many years, and he's written a lot of cycles in it and seen it. So I took many of the pages today that I follow out of his book, and I think you can gain a lot more knowledge from listening to him than from me. So I turn it over to Sam.
That's an unfair way of getting off the dime. Our world has historically been very opportunistic. Our job has been to try and understand what's going on and attempt to figure out how to deal with it going forward. The real estate industry as an industry probably has the greatest single collection of transactionalists of any industry in existence. And I can say that, I think, from a kind of a unique perspective, in that my world is half real estate and half non-real estate. And so I've, bought more radio stations than almost anybody in the United States. I've bought more rail cars than anybody in the United States. I've been involved in some extraordinarily difficult mergers and negotiations outside of real estate. And all I can tell you is, if you want to get a transaction done, there is no one better than a real estate guy. At the same time, and maybe as a corollary there too, that same transactional capability, unfortunately, tends to also create blinders toward conceptualization. And so, historically, what you've had is you've had extraordinarily talented transactionalists who periodically get their ass handed to them because they can't see what's coming around the corner. And worse than that, they spend almost no time thinking about what is coming around the corner. And consequently, we've had a real estate industry, a commercial real estate industry in particular, that has historically had very, very broad swings. Its volatility, frankly, has created a wealth opportunity for me that's far beyond anything I could have ever imagined when I began my career. It required a lot of balls at times. I assure you that being the only buyer in the market is very lonely. And when I tell you the only buyer, I'm not exaggerating. This guy came around in 1992, and he was a Johnny-come-lately. I was there in 1988, 89, and 90, and it was literally nobody else there. And so I tell you this because that kind of volatility led to the excesses of the 80s, which led to the credit crunch of 1990 and 91, which led to the creation of liquid real estate in the United States. I I'm not sure all of you have any idea of the significance of what has been accomplished in the equification and securitization of the real estate industry. In 1991, the securitization industry represented about $10 billion. In 1998, the securitization industry represented $200 billion. In 1991, the equity side of real estate on the New York Stock Exchange represented about $6 billion. Today, that number is about $150 billion. So you've had 30 and 40% compounded growth rates in the equitization and liquefaction of the real estate industry. The argument has historically been, over the last 6 years, this time is different. And this time, because we have equitized, give or take, 10 or 12% of the entire commercial real estate market, we in effect we're going to have the creation of discipline on what has historically been an undisciplined market. We were going to bring real estate into the rest of the economy. We were going to shatter once and for all what I would call a pension fund consultant's reason for being, which is to argue that real estate is non-correlative. I mean, that's mental masturbation taken to the farthest extreme. And in effect, a lot of reasons why the pension funds were led to slaughter in real estate in the 80s is because they had guys who were telling them, don't worry, the rest of the economy can go south, but real estate operates to a different cycle. Well, I don't know where these guys were in 1973 and 74. I don't know where they were in 1981. I don't know where they were in 1987. I don't know where they were in 1990. But all I can tell you is that I've been in the real estate business for 40 years, and I can't imagine an industry that is more correlative to what's going on. I mean, I remember in 1974, I used to get weekly move-outs from our apartment projects. And in 1 week, our move-outs went from 10 to 200. And the next thing I knew, unemployment numbers were dropping and were going up all over the country. And we discovered that apartments were an extraordinary barometer of job growth and job contraction in normal markets, particularly markets where apartments represented the new entrant to the employment market. So the fact that our industry has, quote, finally become correlative is really extraordinary. And we've had the creation of something like 200 real estate investment trusts during that period of time. I might remind you that in 1920, we had over 200 car companies in the United States. So having 200 real estate investment trusts is not so unusual. The likelihood that that number will not shrink dramatically over the next 4 or 5 years is something that I would like. In other words, I think we're going to, in effect, eventually have 10 or 12 major real estate companies. By virtue of the equitization, and at such a rapid pace, one of the negatives is that the managements of these companies are to a large extent untrained at running public companies. And therefore, the distinction between how various companies are run is quite significant. Some of these companies are being run as collections of assets, very much adopting the historic approach where inflation bailed you out. And the name of the game was, if you could carry it, buy it, because inflation would in effect make it more valuable. Clearly, we are in a secularly deflationary period. I personally think it's going to go on for some time to come. I basically believe that that the success or failure, or the distinction between the success and failure of these companies is going to really rely upon who in effect can operate as a real company and who in effect operate as a collection of assets. To the extent that these operators become professional managers, to the extent that they understand what attracts investors. I mean, I could sum it up for you in just a couple of sentences. Transparency, predictability, accountability. That's what the public market is all about. And not, quote, epiphany events, one-time building profits, etc., but predictable and repetitive streams of earnings. In our two particular companies, namely Equity Office and Equity Residential, in both cases, we began with a very simple thesis, and that was liquidity equals value. And if we didn't create serious liquidity in these companies, it really didn't matter what value we created. And so both of them are the largest in their classes. Both have about $8 billion of equity and about $4 billion of debt, both of which have been set up and focused in a manner that real estate has never been run like this before. We basically have created an integrated network, and we operate at scale and size very similar to other businesses, hubs and spokes, and as a result, we are seeing things that, frankly, we've never seen before. First, I tell you, nobody's ever owned 190,000 apartments before. Nobody's ever owned 75 million square feet of office space before. Therefore, nobody's ever even attempted to run networks like this. The results so far have turned out to be much more interesting than we even envisioned. Equity Residential, the apartment company, has now run 8 quarters in a row in which its absolute cost of operation is less than it was in the previous 12 months. In the 40 years that I've been in the real estate business, we have never had a period where we could, quote, run 8 quarters in a row at absolute costs less than the previous year. At Equity Office, year-to-year margin improvement from a 61% margin to almost 65% margin in a 12-month period on a 75 million square foot portfolio is just a staggering result. Both of these things are geared toward operating these companies just like General Electric operates its business, to the low-cost producer. Ultimately is delivery of the victory. And our goal and the methodologies are really focused on operating these companies in such a fashion that in good times we have higher margins than anybody else. In bad times we're profitable and everybody else suffers. And ultimately the speech of the monopolist is to lower your costs to the point where you can force your competitors out of your market. That's something that I would not find foreign or difficult to deal with. My last comment before we kind of open it up and ask everybody to participate is that for the REIT stocks since the beginning of the year have quote-unquote generated a significant amount of press coverage and discussion because, in fact, up until recently, they were down as much as 25% for the year. Everybody was banging the table and saying, "Oh my God, REITs really aren't, going to reduce the cycles. Oh my God, REITs are not the defensive stock that they should be when the markets are difficult. Oh my God, they're overbuilding again." Eric Hemmel at Merrill Lynch in February put out this very comprehensive analysis of all of the activity levels under consideration or started at that time in the office markets, and in effect everybody panicked. What nobody remembered is that the REIT stocks as a whole probably had a compounded 30% rate of return over the previous 5 or 6 years. So a period of pause was hardly out of line. Second, there was a frothiness that had gone into the market. It was too easy to raise capital. And so as a result, everybody got concerned, and the capital was cut off to the public REITs. What everybody hoped might happen actually did happen, and that is that when the money was cut off to the public REITs, it resulted in the money getting cut off to everybody else in the real estate industry as a whole. Over a 12-week period, we had a complete, total meltdown of the entire financial side of the real estate industry at a time when occupancies were at record highs, when interest rates were at record low, when margins in the industry were greatest. All capital was withdrawn from the industry. And the result has been that a significant number of projects and activities that had been considered have been either deferred or eliminated. To a large extent, in a matter of 6 weeks, we have seen the U.S. real estate industry disciplined and materially slowed down. To the extent that anybody owns existing brick and mortar, the value of that existing brick and mortar has gone up in the same 6-week period, despite what the stock prices reflect. Because effectively, all your competition, to the extent there is any, has been deferred. So I think the real estate industry is actually dramatically profiting by virtue of its public position. And I think that what we have done in the United States in terms of creating liquid real estate has effectively become the envy of the world. I mean, our offices are like the United Nations. I mean, people are coming from all over the world, and to a large extent they're relatively naive, and they kind of think that we're Merlin or something, and we have this formula that you mix with lead and you turn out liquid real estate. But liquid real estate is what everybody around the world wants. And if you think about it, we have liquid steel mills, we have liquid pulp and paper, we have liquid car companies. There isn't any reason why an asset class that represents 12.5% of the entire GDP can't be liquid.
I find one other curious point in that, Sam, you talked about the all of the analysts from the big Wall Street houses like Eric Hamill, people like that, who were very concerned about the frothing of real estate and were announcing numbers of what was going to be built in Dallas, Atlanta, so forth. And for just a point, all real estate developers announce everything. And I have very close friends of mine who are Lincoln Property Company, they're friends of Sam's too. When they told me that they had announced 3 million square feet they were going to develop in Dallas, and I called up and said, how can you announce 3 million feet? Oh, it's easy. We're just trying to drive out competition. So we announced buildings we're going to build on property we don't even own. So, but what happens, everybody picks that up and it panics. The thing that I find most curious in it is that...
By the way, I'd like to make sure that it's clear that I don't endorse that statement he just made. He sounds like a typical bullshit developer. Everybody else is lying, but not me.
Yeah, that's right. We're just buyers. We don't develop. But the thing that I find most curious in it is what Sam failed to mention is that the chairman of the Fed wrote a letter to the banks and the lending institutions to back off of real estate lending. He wrote that letter. The thing that I really find curious is he didn't write that letter to hedge funds. All right. He didn't write that letter to Wall Street about hedge fund lending. And look where we are today. Real estate is surviving beautifully. We've gone through a cycle that's going to be very, very healthy. We're in the middle of that cycle. And you have a liquidity crisis for another reason out there that was not mentioned by the Fed chairman, who I think is the smartest guy in the world, next to Sam.
That letter was written on June 23rd, 1998. It talked about the fact that the Fed was concerned about the reduction in standards of the bank's lending, and it specifically made reference to, quote, exuberant lending to the REIT industry. I wrote David Moskow, who is the Fed chairman in the Midwest, and basically told him that they didn't know what they were talking about. That in fact the loans made to the REITs were in fact the best loans that the banks had in their books. The problem was that the banking system was lending a lot of money to developers to build buildings that they anticipated the REITs would be the ultimate buyers for it. So what you had going was you had the banks lending $5 for every $1 of REIT capability of being the takeout. And that, in effect, is what the Fed should have responded to. But so as to give all of you a great sense of comfort, last Wednesday, I had the same Mr. Moskow and two of his shop staff people for breakfast. And they didn't know that there was a credit crunch going on in real estate. And I thought that was less than encouraging. And maybe that's why immediately thereafter all the REIT stocks went up 20% in the next 4 or 5 days. I don't know. But they really didn't know that there was a credit crunch. Now, I think we have somebody here today that we ought to ask to participate, and that is that we have a special guest. It pisses me off because he didn't wear a suit and tie, and I did. But Barry Sternlicht is here, and since Barry is both an expert on stocks going up and down and an expert on not so white knight activities, I thought maybe you'd like to add a few comments as far as real estate is concerned, Barry.
Come on over here, Barry.
Yeah.
Because they went through a very, very bad time, and they profited hugely on the way up this time. They recognize, I think, the highs and the lows of this industry. We're in the process right now of assembling a new source or a new fund that'll be in the terms of $1 billion, because every pension fund recognizes the next 3 months, 6 months, 9 months, a year is going to be a very, very good time to buy. Now, again, we're buying existing assets, and we are a real estate company, so when we buy an existing asset, typically we fix it up and make it into an investment, kind of what we call core real estate investment property, so the day comes that we will sell that. We're not long-term holders. We might be forced into holding longer than we wanted, but we can because we have no debt. But I think just mirroring what each of these guys have said, certainly Sam and I have been through 4 cycles. And in each of these cycles, as money became easier, more plentiful, easier access to it, I always knew the end of the cycle was coming when doctors and dentists became developers. And it happened in every cycle. Every cycle. A doctor or a dentist would rather talk about a development property any day than he would about his own profession. So they became it. I think what's happened is in this go-around, the REITs started to become the doctors and dentists. And they had, in order to sustain, now that's not all the REITs, but a great deal of them, I would say the non-professional ones, the ones who can't manage properly. And the only way they could keep their stock price up was through growth. And if you can't buy properties any longer with the kind of margins we once bought with, how are they going to sustain growth? Well, they got into the development business. Most of them are not capable of developing. I also think it hurts their FFO when they do it. There's ways of going around it where they can buy into a development company. And they got into that. Now, that's fortunately the guys were with us this time. And this is from my point of view, not necessarily theirs. But the guys were with us this time. It got cut off. And the financing phenomenon that takes place, the top end of a real estate cycle, got cut off before it got up there. Now, for us as a private equity investor in real estate, again, with little or no debt, we're in a great place because we can sit here with very, very strong cash flows and wait until it comes back. As Sam and Barry have both said, the actual value of the real estate's gone up because the demand for real estate is just as strong today as it was a year ago. The rents are still increasing in most marketplaces around the country.
But the cash flows have been repriced.
That's exactly
and
what's
therefore
happening.
The values are not there. On the other side of the coin, what I would say to you is that I've raised $5 billion in the pension fund market from a raft of different players. I think that they will not replace the public markets as capital for the real estate industry. They will not do that because, one, the public markets to the pension funds are a big threat. And they're a big threat because they have built infrastructure that's designed to interface with individual investment opportunities. They've also built the infrastructure so that those investment opportunities turn every 5 years or whatever. So, in effect, there's more justification for their existence. That infrastructure is very much still there, despite the fact that the activity level of that infrastructure is down materially. And I doubt very much whether they're really interested in going totally indirect from the historic direct position. I also think that although I agree with Peter, their sophistication has grown immensely in the last 10 years. What Peter didn't tell you was how low it was when they started 10 years ago. Sure. And so the fact that they are vastly more sophisticated today is indicative, or is probably reflective of saying that a child who is 5 is now 5 times older than he was when he was born. But that doesn't make him necessarily competent. And certainly that's been my experience.
You think, I mean, we're raising a private fund now. I think that the public markets, first of all, you're much later in the cycle and everybody knows it. The pension funds are a little smarter than they were back then, and there's a difference between the corporate funds and the state funds. The state funds are the last to leave, the last to get in and the last to leave. The corporate funds are, in my view, smarter. And the corporate funds recognize that you're not buying real estate at 35 cents on the dollar anymore, that the cycle became a development cycle. And in my estimation, they're saying, well, show me how you're going to earn 20% in your 18s and whatever in this environment. I don't believe you. So I think that the smartest guys recognize that it's actually an interesting time to be private and have private capital, but the number of people in like you said, this isn't a very sophisticated group. I don't think there are that many people that are that prescient, and they have a benchmark for value in the public markets which they really never had before. Which is that, in '87 I was working for a fairly small firm called J&B, and in '87 when the stock market crashed, they were closing a little deal where they proceeded to lose all their money called Cadillac Fairview in Canada, and they were short. They were raising $2.5 billion from the pension community, and it was like the day of the crash, and they were short $1 billion, and in 24 hours they got the $1 billion because the pension fund stepped up and said, I just had my equity accounts drop 25% overnight. Real estate looks good. It can't happen in real estate. So they proceeded to lose all their money, 8 years later. But
it didn't take 8 years.
Oh, it took 3.
I think
but the point is, I don't think that happened. I don't think any of us have seen. Have you seen like pension funds come and say, "I got to get into real estate now"? The equity markets have gone into the tubes.
Nope.
I don't see that because they've seen the REITs kind of come in and they're kind of thinking values are down.
But the name of the game historically was, what public REITs have done, what liquid real estate has done, is it is publicly priced.
It benchmarked.
It benchmarked the industry. So you can't sit there in XYZ state fund and pretend it's something else, and thereby invest the money because you like this guy or you've got good political connections or whatever. I mean, this transparency. I mean, it's like there's a guy to whom real estate reports to at the Prudential Insurance Company, a guy named John Strangfeld. And John and I had breakfast 3 weeks ago. And I was talking about the credit crunch, and I was talking about how terrific it was that the industry was being disciplined and there was a governor on it. And I turned to John and I said, John, where's proof? And he said, oh, we're very cautious. I said, well, let me explain it to you, okay, John? 10 years ago, you would get very cautious 3 years and $3 billion later. Because historically, when did anybody yell out in the real estate industry? When the industry was going off the cliff. In other words, when the guys stopped making their interest payments, somebody announced, we have a problem. Nobody ever looked and said, what do you think will happen if this much keeps going? In the same manner, how did real estate get financed? The developer came in with a pro forma to the bank. The developer lied to the banker. The banker knew that the developer was lying. And the two of them agreed that they'd make the deal, and one of two things would happen. Either inflation would bail them out, or the banker would get a promotion before the deal went sour.
Or Prue would provide the takeout.
Right. Well, yeah, but that's what the business was all about. And now you're a bank officer, and a guy comes in with an office building deal. Well, in the old days, you'd come in and say, well, operating expenses are 30%. But he can now pick up an annual report of equity office properties and see that there's 75 million square feet of office space across the United States with an average operating cost of 40%. So how is it you can operate for 20? Well, of course you can't operate for 20. You were just bullshitting to try and make the numbers work. Now people are ridiculously enough asking for equity. We have 4 or 5 pieces of ground in Chicago where everybody wants to build a new office building. And none of them have started. We have one guy, and it's all a con game like Peter was talking about, one guy has a bulldozer, and he started working on the site in June, okay? And he keeps moving the dirt from one end of the property to the other end of the property back to the first end. Because the theory is, I'm moving dirt, so I'm ahead of the other guy. Interestingly enough, the one thing that we haven't talked about, but I think is very significant, and I would be remiss if we didn't talk about it today, and that is that there has also been a change in the commercial mentality in the last 12 weeks. 3 weeks ago, or 2 weeks ago, the biggest leasing broker in Chicago came to see me on something else. I'm kissing him, and I said, boy, you must be having the greatest year of your life. He says, well, 4 weeks ago, we were absolutely panicked because we had all these tenants and we couldn't find space for them. He says, now we don't have the problem anymore because we don't have any tenants. You have seen a repetition of August 2nd, 1990. August 2nd, 1990 was the day Hussein invaded Kuwait. That was also the day business in the United States stopped.
Froze everybody.
Just froze everybody. What I'm telling you is that there has been a very major change in the business community as a result of the last 10, 12 weeks. And part of the reason is, more than any other time that I can ever remember, the guys in charge of the companies in 1998 are to a large extent the same guys who were in charge in 1992. And so we've had 2 major law firms in Chicago that were potentially anchors for 2 new buildings pull out of the market and say, in 1990, the thought of laying off lawyers was, nobody believed that it would ever happen. And then in 1992 or 1991, they laid off lawyers. Guess what? The same guy who made the layoff decision in 1991 is now sitting at the top of Skadden Arps or some other big user of space and saying, gee, maybe we don't need new space because maybe we're going to have 25% less lawyers next year because the transaction side of the world is grinding to a halt. Maybe the merger business is going to grind to a halt. All I'm saying to you, and the same thing is happening in New York City. In other words, some broker who was in an article, I think it was last week, was saying, boy, you better get out there and grab that space because there ain't going to be any more. And then the next line she says, most of my clients are kind of taking a breather right now. I'm telling you, they're taking a breather across the country. And it is going to have an economic impact. And in my own opinion, I see no way that we can avoid a recession in 1999. Now, do I expect a serious one? No. But we are going to have the second hollowing out of our manufacturing in this country. The first one was 1982, and the second one is going to be 1999. You cannot have the currencies of them that manufacture stuff drop by 50% and still manufacture the same stuff in the United States. It just can't happen. Now the good news is the manufacturing side of our country is materially smaller in 1999 than it was in 1982. Therefore, the pain will be less. But
there'll be pain.
Well, there's going to be a lot of pain, guys. I mean, if you make anything, you've got, that is not patent protected or whatever, you've got to be vulnerable. I mean, it's not accidental. Listen, Motorola announced the other day that they were going to stop construction of a huge new chip plant.
$3 billion.
$3 billion chip plant. I mean, and you're seeing ripples of that all the way across the economy.
That's what I didn't when I was saying about the trade deficit. I mean, U.S. manufacturing is going to, profit margins are coming in all across the board. What that means for rents, what will they pay you for rent in a building? That's what the stock market was saying when they corrected for these REITs. Yeah, I love your dividend yield. What shocked me about this correction was that stocks, the REITs, went right through. In a world with no yield, the average REIT was yielding 8-9%. I mean, you had some REITs yielding right even today 14%. What's going on? Well, they were saying that those rents aren't going to be there. When the growth isn't going to be there, then the dividend yield is going down, not up. And so I think they overdid it, but
so
still,
then
they corrected last
huge rally over our companies went from down 30% to down 8 and 9% for the year, which now makes REITs defensive because the average stock on the New York Stock Exchange is down 45% for the year so far, last 12 months from a 12-month high.
What's location have to do with anything?
A lot.
All of it.
I mean, everything. Real estate is still real estate. Real estate is still shelter in one form or another. And by definition, the best located is going to do the best. Just like another part of the equation is that a lot of these companies have an enormous amount of over improvements that the Japanese pay for. Just like location, superior over investment is going to translate into higher security as well.
We're seeing here in Greenwich, we're seeing at 98, in some cases 99% occupancy. You're seeing long-term capital before they were bailed out, making an investment in Greenwich real estate as opposed to Greenwich.
That should have told you so short right there.
There you go, the doctors and dentists. There we are.
I have an operational question. What kinds of things do you do to drive down the operating costs in the office and the apartments? Is it scale purchasing of elevator service or cleaning or electricity?
It's everything. We own 12,000 apartments in Seattle. A year ago, we owned 4,000. A year ago, it cost us $150 an apartment to get it cleaned. Now it costs $100. We own 20,000 apartments in Phoenix. Our landscaping, per unit was $150 a year. Now it's $100. You sit across the table from Duke Power, and you are a $80 million a year user of electricity. You get their attention, et cetera, et cetera, et cetera. I mean, you're talking about economies of scale.
311, Cindy, 311.
You're talking about integrated, operating. It's very similar. I mean, what we're experiencing is somewhat similar to what happened to the airlines when they started doing hub and spoke systems. We're in effect finding that when we bought the second major office building in downtown Los Angeles, our leasing costs on the first one went down $500,000. When we added Columbia Center in Seattle, where we already had 3 million square feet, and we added another 1 million square feet, all of our operating costs on all 3.5 million square feet went down 50 cents a square foot, et cetera, et cetera. So, this is, and by the way, this is not rocket science. This is applying. Remember, historically, the real estate business was a developer who created the product and the brother-in-law who managed it. Okay? And that's, by the way, how important operations work. And the world has changed. And we're, in effect, not only are we recruiting people from outside of the real estate industry to operate our businesses, But we're seeing stuff we didn't, nobody ever thought of before. Because you never had, people focusing on those kinds of things, and you never had this kind of scale. I mean, nobody ever owned 12,000, except for Frack here in New York, who owned 85,000 apartments. No one in the United States owned any kind of serious concentration. If a guy owned 6,000 apartments in Atlanta, he was the biggest player in the market. Same thing in Dallas. It's changed very radically, and it's going to continue to change. I mean, we're at 200,000 units. I think we're going to be at 500,000 units in a few years. And the economies of scale will continue to grow. Just like owning 100 million square feet of office space has all, the ramifications are extraordinary. We have 150 tenants who are, quote, our major core targeted tenant group. That's 150 of them. And what we're getting them to do is tell us what their plans are. So that we bought an office building in downtown LA where we know 425,000 square feet are moving out in the year 2001. We also know that our largest tenant, which happens to be one of the major accounting firms, needs 400,000 square feet in downtown LA in 2001. We're actually going to be able to pull that off. Never happened before. Now you say, why would they tell us? The answer is, you go talk to them today and you say, can you imagine? We did the brain damage and got one lease done with these guys. And now we mimeograph the lease across not only the country, the world. And isn't this terrific? We don't have to put up with this shit anymore. We know that there's consistent quality. We know they're worried about us. All of a sudden, we have a real estate service provider who is as interested in us as IBM is, or anybody else, because in fact, we service customers. The real estate industry has never even thought of that before. And what you find out is the customers, if you provide the service, are not cost sensitive, and in fact will pay a premium for limited brain damage. And they can pay it in a lot of ways. Just by, in effect, sharing with us their plans for the next 5 years is so valuable to us that we can, quote, take care of them in spades all day long because of it.
Well, on that note, I think we're going to wrap it up. Sam, Peter, Barry, thank you all very much for a very stimulating outlook on what's happening in the world. For those of you who are interested in a further perspective on what's happening in the world, our next session, October 22, is on global markets. Michael Sofair and Spencer Land will both be our panelists. Thank you all very much.
Thank you.